So someone sent me a video of Graham Stephan, the banking and finance expert. That's sarcasm. And it's about bank failures are coming. All right, let's check it out. See what he has to say.
Hey guys, it's Graham here, and it looks like it's happening again. Not even a year after the failure of Silicon Valley's Signature and First Republic Bank, another storm seems to be brewing. And no, I'm not talking about the insane amount of rain that California just received. Instead, it's the newest banking crisis that every single major headline seems to be talking about. And just like 2008, it all has to do with real estate. That's right, there's now concerns again that more regional banks could soon go out of business, with the prominent New York Community Bank already having lost more than half of its value in the last few days. Not to mention, there's also the worry that this could soon be the first of many, especially after Jerome Powell's comments that smaller banks will have to be closed or merged out of existence because of falling property values. That's why it's crucial that you understand exactly.
So here's the thing I love about this, okay? So he cites something that Jerome Powell says, and it says, is completely manageable, but he doesn't highlight that. Here's the reality, folks. Banks are not just sitting on these loans like, what do we do? What do we do? What if they don't pay? There's a thing called mortgage-backed securities. They make the loan and then they sell it in the secondary market. It's not sitting on their balance sheet. So this is another one of these, like, I don't understand what the hell I'm talking about kind of things. I do agree there's going to be certain instances where banks have excessive amounts of commercial real estate, portfolio positions, etc. But the vast majority sell them. Like, they literally make the loan and then they package it, they securitize it, and they sell it. So this is a nothing burger with cheese. But let's see the genius continue.
What's going on, how this is going to affect you, which banks are most likely to be impacted, and then finally, what you could do about this right now to make sure you put yourself in the best position possible. All right, so to start, all of this begins with the original banking crisis, which I'll do my best to explain in really basic detail in under a minute. As of now, banks operate under what's called fractional reserve banking. This means that banks are only required to keep 10% of customer deposits available for withdrawal at any given time. Just imagine it like this. You give me your $1,000 to hold on to for safekeeping, but I can turn around and give $900 of that to somebody else, who gives $810 to somebody else, who gives $729 to somebody else. Under this situation, banks hope that enough people give their $1,000 deposits so that when the first person wants their money back, they have enough customers to be able to make up for it. The benefit of a system like this is that customers like you and I get access to a greater pool of money in the form of loans, and we get to earn interest on our deposits. But it also relies on us having faith that the system works and hoping that not everyone is going to withdraw their money at the exact same time. Of course, to be fair, banks aren't lending their money to other banks who are lending their money to other banks who are lending to other banks. Instead, banks simply take your money, loan it out to other people, and invest in very safe assets. This ensures that as long as those investments are held to maturity, the bank will get a nearly guaranteed return, customers will be made whole, and everybody wins. Except today, there's a slight twist. Throughout 2020 and 2021, interest rates were held at 0% as a way to help stimulate the economy during a time where everything was shut down. This allowed people to borrow a lot of money, and as a result, a lot of that funneled back into the banks, which would have been the smart place to keep it. However, like I mentioned earlier, when banks take your deposits, they don't just keep it sitting idle in a vault. Instead, they lend and invest your money with the expectation that they would be able to make a little bit of profit and pay you back some interest as a reward for keeping your money with the bank. Except this time, it didn't exactly go as planned. That is because US banks had so much money during a time where interest rates were at record lows, and because they had such a big surplus, they invested a large chunk of those proceeds into low-yield US treasuries, which plummeted in value once the Fed began raising rates.
All right, I got to stop this for a second. This is so. He's talking about how banks had money at low interest rates. They invested them in treasuries. So treasury bills have a maturity of less than 12 months. So what are you talking about here? This doesn't even make sense. You're trying to like create some sort of like fear mongering out of absolutely nothing. And yes, fractional banking, it's existed for like over 150 years. What the are you talking about? Like, do people not know that? Like, if you go to the bank, like if we all go to the bank right now, we all go to Bank of America, like, let's get everybody to go to Bank of America and take their money. Like, they don't have the money sitting there. This isn't like Like, is this new news to people? In fact, if you go to the average bank and you want more than typically like $5,000, they will tell you, hey, you have to give us a heads up. They literally don't have the money sitting there. But I can kind of see the premise that he's getting to is they have this money invested at these super low rates and that they're upside down, which is totally factually incorrect. It's totally factually incorrect. But let's continue to listen to the nonsense.
This wouldn't be that big of a concern since the banks still technically have the money locked away until the loans mature. But smaller banks were the exception, and when their customers began withdrawing all of their money at the exact same time, that caused a liquidity crisis, which eventually resulted in 3 banks completely collapsing. So what does that have to do with today?
Nothing. It actually has nothing to do with today. So when you look at Silicon Valley Bank, okay, because that's the one that everybody keeps bringing up, if everybody goes to get their deposits at the same time, okay, no bank has that money sitting there, all right? They've lent it out. It's in your house. It's in your car, okay? It's not there. So not an issue if there's enough time. But if there's like a crisis in confidence, which is exactly what happened with Silicon Valley Bank, then totally different. Here's the interesting thing. I literally know the banks that bought Silicon Valley's portfolio. It's actually a fantastic portfolio, and they're going to make loads of money from it. But the idea or the insinuation here is like they made bad loans and that no, everybody went to go get their deposits. There was a fucking short squeeze on the stock, by the way, and it was actually told by a hedge fund manager, I would take my money out of there. Everybody goes, game over. So Silicon Valley, like, let's just call a spade here. If that happened to any bank, it could be Bank of America. They don't have the money. Okay, so let's go back to the videotape here.
The banks of 2023 had their money tied up in low-yield U.S. treasuries that had lost a significant amount of value. Today's banks have their money tied up in another asset class that's also not doing well, and that would be commercial real estate. So
this actually is making my brain hurt. I might have to like pause this for a period of time because I'm getting heated. So when a bank makes a loan, all right, there's very few banks that will actually hold the loans. There's a whole other market, a multi-trillion-dollar market called the securitization market. They make the loan, and then what they do is they package it with a bunch of other loans and they sell it into a second market, okay? It's a secondary market, it's securitization. Mortgage-backed securities. There's residential mortgage-backed securities, there's commercial mortgage-backed securities. So they're not making these loans and then sitting there like, oh, I hope they pay. I hope we get our money back. No, dummy. It's not on the fucking balance sheet anymore. This is a nothing burger, but let's listen to the madness.
Where treasuries paid you next to nothing and bank deposits paid you less than 1% interest if you were lucky, commercial real estate was booming because you could borrow money at 1 to 2% to buy a property that earned you 3 to 4%. Because of this, commercial real estate values soared between 10 to 30% depending on the type of property. And banks were the ones issuing all of these low interest rate loans because they were flush with cash.
All right, let's stop right here. Okay. The loans for commercial real estate, vast majority of the time, are floating rate. So the point that he's trying to get at is they made these super low interest rate loans and everybody's stuck. Like, that's total horseshit because these are typically floating rate loans, not fixed rate loans. But let's continue the madness.
However, now that interest rates have increased at the fastest pace ever in history, there's a problem. Commercial real estate values are plummeting, with Morgan Stanley estimating that the entire market could decline 40%, which is the same magnitude that we saw throughout the 2008 financial crisis. Why is this such a big deal? Well, as CNN explains, U.S. banks hold about $2.7 trillion in commercial real estate loans, and about 80% of that is held by smaller regional banks, the ones the U.S. government has not classified as too big to fail. Now, unlike most normal real estate loans that you and I would get when going and buying a house, commercial real estate loans are not fixed for 30 years.
Exactly. Well, this is like the smartest thing he said thus far. They're not fixed. They're fucking floating, which means as rates go up, the banks end up getting those higher rates. Now, I know what he's trying to get to. I can already think ahead. I got my little magic ball here. He's basically saying that whomever has these loans, i.e. the borrowers, are not going to be able to pay because of the higher rates, okay? Now, here's where I'll give you this. Office real estate, definitely getting crunched for sure. But this idea like all of commercial real estate is going away and all these banks are going to fail. The commercial mortgage-backed security market is alive and well, and it's off the bank's balance sheets. But let's continue.
Interest rates often reset after 3 to 7 years, much like the introductory rate mortgages that we saw in 2005. And according to the data firm Trip, more than $2.2 trillion will come due between now and the end of 2027, so regional banks could have problems collecting on these loans. After all, commercial real estate values are almost entirely dependent on two factors: how much a property earns and how high interest rates are. In this case, the higher the rates, the higher the return an investor needs for the deal to make sense, and as a result, values drop. Like, just imagine in really basic terms that you have a $1 million building that makes $60,000 a year, which is a 6% return. If interest rates decline to 1%, that building could sell for $1.5 million, or a 4% return, since you could borrow at 1% to make 3% in profit. But if interest rates spike to 6%, that building could only sell for $666,000, or a 9% return, since now you'd have to borrow at 6% to make that very same 3% profit. So why do all these banks have anything to do with this? Well, the other week,
Nobody knows.
The bank reported a surprise loan loss of $552 million, driven partly by expected losses on commercial.
All right. There is a whole piece of this that relates to valuation. Okay. As rates change, values change. So, like, real talk, simple math. Let's say you have a property that earns $100, okay, in income. All right. And there's a cap rate, or like a market rate, of 5%. Okay. So you take the 100, you divide it by 5%. So it's basically 20x. It's $2,000 of value, that property. Okay. Now, the point that he's trying to make is, if rates go up to 10%, what happens to the value of the property? Well, you're going to take the 100 divided by 10%. It's now worth 1,000. So it's a 50% loss. Everything in accounting, everything in finance has to be marked to market. Okay. These are what are known as losses, but they're not actual losses. So it's not the same as the loss of selling a property and losing the money on it. It's just a paper loss. Now, as long as the tenants are paying on those properties, it doesn't matter what the quote unquote value is of these properties. Frankly, it's irrelevant. So if you have a property, what his premise is if you have a property that's cash flowing, that's making money, and on paper it's worth less money, you lost money. No, you didn't. You're still making the income on this property. So the premise here is just faulty. And what he's talking about is bank accounting, which he definitely knows nothing about, for God's sakes. So when you have losses on your books, you have to reduce the value of those assets. Okay. That's a principle in accounting, conservatism. So yes, that is true, but it's not the same as an actual loss. So for example, if you lose money on a stock because it went down in value, you don't actually lose until you sell the stock. But let's continue here.
Germany's largest lender, Deutsche Bank, also said that they allocated $133 million during the last quarter to absorb potential defaults on its U.S. commercial real estate loans. That's more than quadruple the amount.
Okay, now he's like well out of his scope, if he wasn't already. So now he's talking about a thing called a contingent liability. If you anticipate a loss, what you do is, instead of feeling it in the future, you say, I think we're going to lose 100. This happens often with legal claims, or like, slip and falls, stuff like that. You're in a lawsuit, you have to spend lawyer fees even if you win. So therefore, you're going to allocate a liability called a contingent liability. Again, this is all accounting, so that you can absorb the loss if it occurs. But guess what? If it does not occur, you get a benefit, because a reduction of liability is a benefit. Continue.
Set aside during the same 3-month period in 2022. The risk in this case is that it's quite easy for contagion to spread throughout the rest of the market and cause values to...
All right, now he's talking about contagion. He just used the example of Deutsche Bank. and that there's going to be a contagion spreading throughout the market via Deutsche Bank, which is a German bank, actually one of my former employers, and that's going to affect regional community bank. Okay, let's see this. By the way, the regional community bank is not backstopping loans in New York City. Just an FYI.
Mine even further. After all, sales of financially distressed properties can reduce market value of nearby properties and lead to a broader downtrend valuation spiral. In response to this, Jerome Powell said that there are some smaller regional banks that have concentrated exposure in these areas that are challenged, and we're working with them. It feels like a problem we'll be working on.
Hold on. So he's quoting Jerome Powell, and he's only partially quoting him. So he said, it doesn't appear to have the makings of the kind of things that we've seen sometimes in the past, for example, with the global financial crisis. Jerome Powell is literally saying, not going to be an issue compared to what we saw in the past. But let the fear-mongering continue.
For years, it's a sizable problem. To make matters
He
worse,
literally left out the second part of the quote.
happens to be the largest, and that would be office space. According to the Wall Street Journal, as work from home picked up, 19.6% of all office space is now vacant, which is the highest level since 1979. As they say, many office parks built in the 1980s and earlier struggled to find tenants as companies cut back on space or...
All right, I'm going to totally blow this up right here, folks. So if you bought real estate in the 80s, that's 40 plus years ago. It's probably fully depreciated at this point. You probably bought it for like 20% of what the current value is right now anyways. What are we talking about? The premise that he has here is that in 2020, when rates went to 0%, everybody sold commercial real estate. Every single holder of commercial real estate, particularly office real estate in the United States of America, sold it to some schlep who said, oh, this is a great idea. COVID, nobody's in the office. I'm going to go buy this real estate. And now they have these loans that are coming due and that they're all going to be screwed. This doesn't make any sense, folks. If you bought something 40 years ago, you're not exposed to the value that it is today. I guess the other premise he's making is everybody took like a 90% loan to value out on all of these properties, and now they're not going to be able to pay. It's madness, but...
for more modern buildings. The Atlantic even called this out 8 months ago, saying that the next crisis will start with empty office buildings, and pointing to the fact that a third of all office leases are expiring by 2026. From there we go.
What is happening here is what's called cherry picking. So he's cherry picking data to create this like fear mongering bullshit that has no basis in fact. He talks about properties from the 1980s, which are 40 years old and were probably bought at like 20% of their current value and are fully depreciated as well. So the premise is they all took out loans at 0% in 2020 and now they're all screwed. Something tells me that someone who's a savvy investor wouldn't do a bonehead move like that. But here's the other thing that's fascinating. It says with a third of all office leases expiring by 2026. Typically, companies don't have long-term office leases. They don't have 15, 20-year office leases, and just so happens that they're all coming due in 2026. So this is just like madness on an egregious scale here. If you think about it, office leases, if you've ever rented office space, you have a 1 year, maybe a 2 year. Most landlords won't give you a like more than 2 year lease because they're not going to be confident that you'll still be in business. And they're going to approach you about a year into the lease to see what should happen. You know, are you going to renew next time? Do I need to look for someone? Typically, you have to let the landlord know if you're going to be leaving like 6 to 9 months before the lease comes due. So again, like madness here. This is someone who's very, very far out of their scope. They probably had some clowns go on ChatGPT and do some freaking research, and now they're cherry picking the data to come to like their own conclusion.
Significantly lower rents or both. This is also happening at the same time that 25% of office building loans are coming due in the next year. And with rates now 5 times higher than they were a year ago, ownership costs are going to go a lot higher. And if you thought this was the end of it, oh no, it continues. According to the National...
Let's hold the phone here. Again, this is all predicated on the assumption that all of these loans are at the banks. Let's say all these loans are screwed, like nobody's going to pay them, They're in the secondary market. banks aren't going to lose. Investors in these securities are going to lose. Like,
15% of all commercial real estate loans and 44% of loans in office buildings appear to be in a negative equity position, meaning the debt is greater than the property's value. As they say, that increases the risk that borrowers won't repay and will default on their loans, which eventually falls back on.
So again, this is another nothing burger. If you have a loss, a paper loss on your piece of real estate, you're still getting paid. The leases are still good. Like, you don't care that on paper it's worth less money, and it's not worth 50% of what it was. Like, this is just totally bananas.
Banks that may or may not have the ability to survive the loss. So is this actually something to worry about? Although before we go into that, I am sure that most...
I can answer that, Graham. No, this isn't something to worry about because, again, all of these loans are sold in the secondary market. They make the loan and they don't hold the loan. They sell them off. It's called securitization. Folks, look something up. It's called CMBS, Commercial Mortgage-Backed Securities. The vast majority of banks do not hold these loans. They sell them in the secondary market. So this fear that the banks are sitting on the loans like, oh, I hope they pay, I hope they pay, is just total fantasy. It's not true.
Of us aren't sitting around worried about what's going on in the commercial real estate market. Instead, we're paying attention to what's actually going on in our day-to-day lives. And for most people, it's the realization that utility bills have increased substantially over the last few years.
Here's a pivot.
Mention, blackouts and power outages have also become way more common, especially throughout California during the recent rains. So to help with that, I've been using our sponsor, the EcoFlow Delta Pro Ultra, as my go-to backup power source because they're the most powerful and flexible home backup solution.
So we've now pivoted to all of the regional banks are going to go out of business. We're going to have this contagion. All office real estate's gone. All commercial real estate's gone. And if and when that happens, there's going to be more blackouts. And we've been having a lot of blackouts. So go buy this battery that I sponsor. Okay.
The worst case scenario, according to a regional banking analyst, is if inflation goes back up, forcing the Fed to keep rates higher for longer, and the U.S. economy enters a recession.
It's a big if.
Would then have problems keeping up with the...
All right. If inflation goes back up, which it's down, if it goes back up, forcing the Fed to keep rates higher, the Fed's already said, like, we're lowering rates. It's not a matter of if, it's a matter of when. They're freaking talking about like 2Q, 3Q. And the U.S. economy enters a recession. So inflation goes up, rates stay high, and the economy enters into recession. The trifecta. Conclusion, borrowers would then have problems keeping up with their loans. Okay? But hold on, the next part, which he's not going to highlight here, folks. If those things don't happen, which they're not, the commercial real estate pain should be manageable for the banks. Inflation's not magically going back up. It defies all logic. It's fucking backwards looking, people, okay? And the Fed keeps rates higher for longer. The Fed's already telegraphed. Look at the dot plot. I know Graham probably knows all about that. He could probably teach me about that. The dot plot's already going down. So the rates aren't going to be higher for longer. So now we're 0 for 2. Borrowers would then have problems. Oh, and the U.S. economy enters into a recession. I think that's in the rearview mirror as well. Then they'd have problems. All right, so another nothing burger here, folks. If those things don't happen, which all three are not going to happen, the commercial real estate pain should be manageable for the banks. It's like, so we found that out 10 minutes into a 13.5 minute, 14-minute video that this is a nothing burger. Thanks. Too late. We already clicked.
Loans. But if those things don't happen, Jerome Powell said that there will be losses for the owners and for the lenders, but it should be manageable. He also went on to say that the economy's strong, the labor market's strong, inflation's cooling down. We don't have a perfect crystal ball about the future, and things could happen, but I do think that the economy is in a good place, and there's every reason to think it can get...
So everything that he just cited as being like the, oh my gosh scenario, we're screwed, he literally just countered with everything that Jerome Powell said. Economy's strong, no recession. Labor market's strong, no recession. Inflation's coming down, it's not going up. What are we talking about here, people? What are we talking about here? And then he said, I do think the economy is in a good place, and there's every reason to think it can get better.
The other good news is that not all real estate markets are at risk. And surprisingly, the commercial real estate market is made up of several segments that are actually doing quite well. Like Bloomberg recently reported that vacancy rates for warehouses and industrial space is low. Retail vacancy is only 5.7%, and hotels are garnering record revenue. In addition to that, about 3/4 of commercial real estate debt generates enough income to pass banks' recent refinancing standards without major changes. And delinquency rates as of now are only barely higher than they were pre-pandemic. Office space, though, is probably the exception to this. For example, JP Morgan warns that 21% of office loans are destined to go bad, with lenders losing an average of 41% of the loan principal on the failures. Because of that,
and here's the thing that I love about this. It's just big numbers that get thrown. 21%, 41%, but there's no context given. So you're like, holy, 21%, what the hell are we going to do? 21% of what? Of what? 41% of what? Like, there's no context. Great research.
Their lending, be way more cautious about who they lend money to, and
banks have already scaled back on their lending. This happened like back 10, 12 years ago. Like, that already happened. That story has already occurred. And then when rates went up, obviously it was scaled back. So like, there's a further scale back. Like, this doesn't even make logical sense. This is just bananas here.
Personally, that'll affect you the next time you go and apply for a house.
No, wrong. This is now he, like, beyond the fact that he's completely like out of his scope. Like, he is so off the beaten path, it's not even funny. I'm just like, my brain is actually hurting with this. So he's saying because of the office real estate market, that's going to affect the average Joe and Jane who's going to get a real estate loan on a residential property. When, and if you watch past videos, I hope to God that he said this, we actually have a massive deficit in supply, such that even with rates going up, we haven't even seen a major increase in foreclosures. There's not enough supply to match the demand. So what he's saying is another nothing burger where it's like, oh, it's going to be harder for us if the banks lose money on the office loans. The office loans which they don't hold anymore because they sold it in a secondary market, and they're not going to give you a loan for your house, which they're also going to sell in a secondary market and not hold anyways. Okay, right.
Any of the bank's money. That's why I think if you're looking to invest in real estate right now, don't be afraid to take your time, make low offers, and really evaluate if the property makes sense to purchase long term. I personally believe that if you find a good deal, real estate could still be a great opportunity. But short term, we'll probably continue to see banks scaling back and making it more difficult to get a loan.
Look, I'm a fan of real estate also for the long term. All right. If you're going to buy real estate, your mindset should be that you're going to hold it for at least a decade, if not longer, unless you're trying to take advantage of Section 121 of the tax code. You're going to live in a property for 2 years. You're going to sell it tax-free and upsize from there. I get that. But outside of that, yes, of course, you always want to buy real estate at a discount and look for deals and make offers below market value. Oh, this is unbelievable advice here, folks.
In terms of people who hold their money with regional banks, as we've seen, there's always a small risk that something could happen, as evidenced by the failures and bankruptcies a year ago. But in those cases, FDIC insurance made all of those customers whole to the point where none of them lost any of their deposits. Instead, the losses were really limited to just the investors and people who bought the stock, which is really the same for any company that you would invest into. For that reason, unless you keep more than $250,000 worth of cash in a smaller regional bank, you'll probably be fine. And if you keep more than that within the bank, based on the previous events, FDIC insurance kicks in and makes sure that all customers come out unscathed. Of course, full disclosure, this is only based on what happened a year ago. Now, in terms of New York Community Bank...
Hold on. He said, full disclosure, this is only based on what happened a year ago. I guess he's referring to Silicon Valley Bank. They actually went above FDIC limits. The government backstopped everybody, even if you had more than $250,000 in the bank. So that precedent is actually very positive for us and very negative for banks, from the perspective that the government is probably going to regulate you in such a way that you're going to have added requirements beyond FDIC backstopping you. And beyond that, if you have enough cash that you have more than 250K, yeah, you should diversify amongst a bunch of places. You want to have a place where you could get your money wherever you go around the country, not have to pay, ATM fees, blah, blah, blah. But your FDIC insured up to 250K, that's not going to change. The premise here is regional banks made a ton of commercial real estate loans. All of these loans were office real estate loans. They were all made in 2020 at 1%. All the loans are still held by the banks, and now they're coming due, and nobody's going to be able to pay them. So, like, every single one of those premises is completely wrong and false.
Analysts at Bank of America cited feedback from management that New York Community Bank was not experiencing any unusual deposit activity. However, their share price has continued to decline by a lot, so investors aren't exactly optimistic about their short-term future, despite what the analysts say. Oh, and also, if it's not already obvious, I have no clue what I'm talking about. Don't listen to a random guy on YouTube. Anything can happen. Consult a professional.
That is the most salient point that he has made the entire video. I'm actually going to clap for that. Like, that should have been put up front. I gotta rewind that. Hold on. Let's hear it again.
Not already obvious. I have no clue what I'm talking about.
If it's not already obvious, I have no clue what I'm talking about. No, Sherlock. Ha!
Don't listen to a random guy on YouTube.
No, don't listen to a random guy on YouTube. Also, don't listen to a random guy on YouTube who didn't go to college for finance, economics, does not work in finance, economics, has no background in banking at all whatsoever, has no finance designations, has no economic designations, has no background or basis in it at all whatsoever. I agree, Grant. You're 100% right there, bro.
Consult a professional for your own specific situation, and all of this is purely just my opinion. Anyway.
You have the right to your own opinion. You don't have the right to your own facts, Grant. You have the right to your own opinion. You don't have your right to your own facts, okay? This is madness.
Is something to consider. There is a chance this crisis does continue getting worse for certain banks, and it's a good idea to at least know what's going on. But based on nearly everything before us, so far customers have not lost any of their own deposits at the bank, and it's always worthwhile to be a bit cautious on what's going on. As well as hit the like button and subscribe if you haven't done that already. So with that said, you guys, thank you so much for watching. And don't forget that you can get some free stocks down below in the description with a paid affiliate link when you make a deposit, because those stocks could be worth all the way up to a few $1,000s. Now, keep in mind, I do get a commission if you sign up, but you also get some free stocks. So let me know what stocks you get. Thank you so much, and until next time.
Yeah. So the caveat at the end was actually the best thing. He said, I don't know what I'm talking about. That should have been up front. Like, that would have been the hook for the video. Hey, everybody, just want to let you know, I don't know what I'm talking about. I just make videos on YouTube. I hire third-party people to get me information. I smash it all together, and hopefully I make some salient points. Not only, yes, you should look to a financial professional or a financial advisor for advice. You shouldn't be looking at or listening to people that don't know what the hell they're talking about and just giving their opinions. All right, that's my reaction to the madness that is Graham Stephan, and bank failures are coming. Do this ASAP. Bank failures are not coming. And by the way, there's no ASAP that he gave. Have a great day.